Good morning. My name is Adishan Naidu, and this is the Market Pulse. I'm joined once again with Tom Gale, Executive Trading, Global Markets, Standard Bank. Tom, good morning. Good day.
Hi, Addy, and to the audience.
Well, as we know, weekly we're trying to get this out, but there's like so much to cover. There's Trump, there's tariffs, there's gold. I feel like the topics are obviously continuous, but I mean, there's just so much news coming out all the time, and hopefully you can help the audience make sense of what's going on. I mean, there's so much.
Yeah, as you say, once again, we're spoiled for choice. You and I, Addy, we chatted last week about, what might be in store in 2026. It's the second year of the second term for Trump, and typically those are tough years for any sitting US president. And this one will be no different. He's facing enormous challenges. Actually, we would have covered Trump's historical disapproval rating. He's very unpopular, is Trump at home. Believe it or not, you'd be forgiven for missing that point. And often when presidents are facing problems at home, they will deflect attention to foreign policy. So, we're certainly immersed in all that right now with Greenland and what have you. All of this, of course, benefits gold. And we talked again. It's a repetitive topic on this call of just how well gold is doing, but not just gold, platinum as well. The two have some correlation, of course they do, but platinum also does have its own specific fundamentals, which our precious metals analyst, Adrian Hammond, is positive on. So your audience will remember by now, Addy, and you'll remember that we have a forecast for the gold price of $6,000 an ounce by next year.
But I mean, that's all good and well, but I mean, we're at 4,869. That's spot right now. I mean, 5,000 seems like it's on the horizon very soon. So we still got 11 months to do another 1,000. And I mean, correct me if I'm wrong here, Tom. We did 2,500 in a space of 7 months last year.
Yes, of course. It's been a precipitous rally, and we haven't been short of investor inquiries and discussions around whether it is sustainable. And typically in markets, as in life, things that go up in a straight line do have moments of correction. Of course, there's some sort of reversion at some point. So of course, and I think the third quarter last year, Addy, you and I were talking about a bit of a middling period for gold, and we said please don't short it. It's definitely not a short. It's something to be bought on dips and so on. And of course, the global picture is fluid. It doesn't stop. We don't have a static period of time where things are not happening. So of course things adjust. The other thing I would just say is to add some caution that just because we say $6,000 an ounce doesn't mean that is a hard fast stop. And once again, things will change, and we will revisit our forecasts and so on. But the point is that we still see upside, and platinum has overshot our official forecasts, but still our analyst remains constructive on the underlying fundamentals. So it will also hold its gains and could still go higher, partly because of partly because of what gold's doing and so on. I don't want to
ask a question though before you move on from it. Is you've got gold and you said platinum. I mean, there's a very very tied back to SA, but I mean, in terms of what's going on politically, I mean, you've got Trump there with a nice little flag. I mean, there's a whole meme around him with the taco trade. I mean, you can unpack that a bit more, but I mean, we see that a lot with uncertainty, and we saw it a lot last year, Tom, that a lot of times when markets are this uncertain, or when there's so much geopolitical uncertainty, we almost use the metals as a safe haven. And I mean, you haven't spoken about it as often, but can silver tie into that as well? I mean, are we seeing silver going up based on the back of usage, or is it a safe haven, another safe haven alternative to gold? Because silver's also at an all-time high, if I'm not mistaken.
Okay, so yes, it's a good question, and silver has been trading around the mid $90 mark, which is also historically high. That's right, and silver has far more industrial use than gold, for sure it does. But actually, the rally there has been driven by call it what you like, speculation or safe haven buying. It has a close correlation, silver, with gold. And so once again, we do monitor closely actually here the gold to silver ratio, but otherwise I think for the all intents and purposes here, we can think of them as broadly speaking as risk indicators, one and the same. I don't want to dwell too much on these topics. We've covered them at length, and I think the abiding message here today should just be that we remain constructive, and we'll come on to the implications for that shortly. But the world is not without its risks, and markets are not without their risks, and one perhaps that can easily be missed amid the Greenland headlines is what's going on in Japan. And Japan is relevant because Japan has incredibly high levels of debt. In fact, Japan has had incredibly high levels of debt for many years, and in fact decades. It is rising. The point, however, is not necessarily that Japan's had a lot of debt for a long time. It's that rates are now climbing in Japan, and for many years and for most of my career, the Japanese monetary authorities have kept rates at very depressed levels, and for many years in negative territory. And when that's the case, of course, debt servicing is very simple, and so we haven't had to deal with chickens coming home to roost. What's changed recently is that there's a little bit of inflation that has presented itself in the Japanese economy. A little bit of inflation is okay; it will inflate away debt, but the problem now is that things are largely seen as unstable. Rates are climbing. As rates climb, it becomes more difficult to service the debt. What I'm sharing with you and your audience, Adi, here is some data from the Bank of International Settlements, which ranks total non-financial debt to GDP. There's many ways to measure a nation's debt, and we mustn't end up down a rabbit hole here in this session today. But what's interesting about non-financial debt to GDP is it's typically debt that doesn't create an asset on the back of it. It tends to be used to service, let's think of it as everyday spending. And with a non-financial debt to GDP ratio of 380%, Japan is by far the most indebted nation in the world. As I said, they've managed over recent years through growth and through suppressing monetary policy to manage the debt load. But things are changing, as I say, and the service ratio of that debt right now is 16%. That is to say that income to debt service is 8/1. But we're going to see that go up rapidly as rates are hiked. What's interesting is that there's a move to more populist policy in Japan. That's likely to come with a snap election on the 8th of February. The current Prime Minister, Takaichi, has called this election to shore up her power and give her a mandate to change meaningfully government policy. I want to just flag the risks here. As the yen has been weakening, and the cost of servicing Japanese debt has been climbing, the market has really become averse to holding Japanese debt because it is becoming increasingly unserviceable. The authorities will have to do something about this, and one very convincing theory is that Japan can use ultimately its foreign portfolio assets, which amount to something like $5 trillion worth, if they choose to bring those home to help service debt and shore up through capital repression the local domestic debt landscape. I'm sharing here the performance of the yen on the left in the white line. The yen has been very weak. We all know a lot of people who have been to Japan on holiday in the last year or two. It's because, of course, the yen has been performing very badly. You think that the rand over recent years has been bad. Well, the yen has certainly been very poor. It makes it rather cheap to actually take your rands to Japan. The chart on the right is a multi-year chart of how Japanese borrowing costs have started to rise quite significantly in recent years. Again, this makes it incredibly difficult for the Japanese authorities to service that huge debt load that they have. Adi, I want to move on. I want to move on to say that Japan, the volatility that has been surfacing in the yen and in yen assets is one risk that we're monitoring at the moment. Of course, there are many others, and you and your audience will be familiar with a number of these. We talked last week, Adi, you and I, about the cost of living crisis in the US. Certainly, many people in the US are feeling the pinch of higher prices, but stagnated wages. It's making life experience rather hand to mouth, and so these are experiences that do bring about populist policy. Populist policy has big implication for markets. We've talked about currency volatility as it relates to the yen, certainly, and of course we could spend some time on the dollar. We won't today. We could talk about tariffs and Trump and great power geopolitics, but I think we've given that enough airtime recently. What I would say, I want to just say for now, Adi, that for the time being, we think markets will keep rallying. That sounds odd, doesn't it? After
it does sound odd, because I'm going to ask, because I mean, US markets were closed on Monday, their futures were down, their markets are down, our market is kind of not sure what to do. So which markets would keep rallying? I'm just out of question for the audience here. I mean,
of course, yeah, and besides, we've just spent the last few minutes talking about some of the big risks to markets. Well, sometimes I like to compare markets, especially in the last year or 18 months, as dancing on the edge of a volcano. You don't always know when it's going to erupt, and we had a couple of shocks in the last couple of years, not least last year around April, and we've got to be on alert for those. I just want to explain what you're looking at first. So these are borrowing costs of yen bonds, long dated yen bonds, and 10-year dated US bonds. A lot of US allies have been selling US treasuries in recent days in protests at US foreign policy, and so debt yields, debt costs moving higher is a risk. But just over the last overnight, at least, those borrowing costs just coming down again, partly because the Japanese have stepped in just to manage the market their side, stabilize things. Also because I think that there's a fair chance that we'll see Trump somewhat diffuse the crisis over Greenland at Davos later today. And if he doesn't, there's still an off-ramp, but it's just that the Europeans will have to take the off-ramp by acceding to some of his demands. Europe really doesn't have much choice, I would argue, but to find some middle ground with the US, perhaps where US doesn't take over Greenland, but US is allowed to station a bigger contingent of armed forces and has access to mineral rights and so on. So I suspect that we'll see that particular problem resolved, but of course we in trading here we do live day to day, at most just week to week. I think markets are going to rebound today, and it could last through the rest of the week.
Okay.
You asked me. I'm getting to your question, Adi. I'm getting there.
Yeah.
You asked me which markets. Well,
That's kind of where I'm kind of where I'm trying. You say it's going to rally through the week, okay? So I'm trying to figure out which ones, or give an indication here.
okay. Well, the answer in one word is collectively. So in other
Okay.
words, all markets can rally. We'd be a little concerned if you wanted to put me on the spot over some specifically some markets. We all know that the S&P underperformed last year. In fact, if you stripped out AI from the S&P from US markets last year, the US was a laggard in terms of its equities performance, and that's going to continue. Adi, you and I have been talking for some time about how South Africa can and will outperform the US
Yeah, we did.
and many other markets. That's absolutely what has happened and what will continue to happen. So here I'm saying EM, which are emerging markets, will
Yeah.
perform better than DM, which is developed markets. And just to run through, we don't have to delve into detail here, but there's a good story for emerging markets at the moment. Typically tighter balance sheets. We were talking about Japan a moment ago, and it's bloated. Effectively, it's bloated balance sheet. So too France, and to some extent the US. Well, that's far less the case for South Africa, for example. And please excuse my spelling
I was just about to
mistakes
ask
as we go.
because I was looking at higher real raise, but I'm thinking that's right.
Yeah, you mustn't judge, please. So I got there. There we go. You should be able to see a
Yeah.
correction. Higher real rates. That is to say that we have real returns for investors in currencies that are well anchored. So if investors borrow in dollars, for example, and convert to rand, the rand outlook they would see it is pretty good. You and I have also discussed this, and then you just collect a real rate. So in our bonds, you can collect an 8% yield, for example, 8 to 10% yield, when our inflation is just 3 or 3.5%. So that's a real that's a real return. The other thing to say is that South Africa and many emerging markets are less well owned. Well, just think if Japan is forced to repatriate its foreign portfolio of assets. It's not that most of the $5 trillion is sitting in South African equities. We know that to be an absurd, unlikely thing. It's sitting, of course, most of it's sitting in developed markets, in the US, in US tech, and so on. So South Africa is less well owned. So if assets are pooled by any nation looking to bring capital back home, well, EM is generally less well owned. It's certainly true of South Africa. Many emerging markets are commodity producing, and commodities. The outlook for commodities is very constructive. We would argue it has been and will continue to be. Emerging markets have learned. South Africa's learned from the Zuma era, and many emerging
last week on that Zuma and Becky area.
Yeah, well, well, that's right. You recall the chart that we discussed, showing the improvement. We've learned, and in fact, many emerging markets have learned from crises stretching back to the turn of the 2000s. And it's also true to say that emerging markets typically have better demographics, not necessarily China, for example, but just perhaps pull an example of Japan, where the population is aging fast.
Well, I don't want to put you on the spot in what you just said, but I mean, you mentioned at the top of the slide that obviously EM should do a lot better, and DM in terms of like the US market, a lot of its gain last year was due to AI. You did mention it quite previously last week. I don't want to kind of as I put you on the spot with it, but the AI is it a bubble right now? Are we going to see that if that obviously pops, for lack of a better term, are we going to see the US or the DM market kind of pull back quite extensively, and that's where there'll be even more yield in the EM market?
Well, I think if we see a bursting of a bubble, it will be a knee-jerk bad for everyone.
Okay.
But you could argue if South African assets are less well owned, then yes,
We
you know,
still survive.
there's a silver lining. But
Yeah.
you asked me, is there an AI bubble? I think it's highly likely that there are bubble stocks within
Okay.
and bubbles within the broad AI themes. Some
Okay.
of it's not, some of it is. But one thing I've learned over 25 years in market study is that you cannot time these things. It's impossible to time. And many,
Sitting on a beach, Tom. You said this
well, we
before.
were sitting on a beach, and there are many individuals much smarter than me who have tried to time and got it wrong, and their careers have hit the rocks as a result. Let's talk about the Rand briefly and SA. We'll begin to wrap up, but I just want to make the point that our outlook here in trading on the trading floor is for a firmer Rand, eventually a Rand that has a 15 number in front of it. But in the short term, it's unlikely to happen. And by the short term, I mean our horizon in trading. So for the next couple of weeks, it's unlikely. There's this big level of support for the dollar Rand that I would identify as 1632 to 1634. That's a level that we probably continue to bounce off. There are a number of reasons, but we have heard from the governor of the South African Reserve Bank that he wants to increase dollar reserves, which is a prudent thing to do. These are often useful signals, and it probably partly helps explain why the Rand hasn't made any real fresh headway this week, despite gold having rallied further. But
To ask on that quick point, I mean, as you said, the Rand's at 1633. That's where spot is currently. I mean, you kind of highlighted that level quite nicely on the graph. But I mean, is that Rand strength because of? And I mean, you mentioned our governor, but is that Rand strength on the back of us as South Africa, or is that dollar weakness in general for what's happening in the US, or is it a bit of both?
yep, it's a bit of both as usual.
Okay.
But for those in your audience who would just put it all down to a weak
Effects, yeah.
to a weak dollar, that
Okay.
that is missing the point, and it's missing the point because actually South Africa is earning a lot of dollars right now. It's what we would refer to as a terms of trade spike. Eleanor Moorman, our South African economist, has got very excited about the impact of this terms of trade spike, courtesy of our mining sector that digs out partly platinum and gold. They're our biggest export receipts, and those are those are dollars that are earned, and then those dollars are sold to bring Rand back to Rand denominated companies. So it's partly a case of corporates here having to sell dollars but actually buying Rand, and it's also then a case of fundamentals and the basics actually just getting better here.
Okay.
SA growth is weak. It has been weak for some time, but it's improving. And again, in markets and in economics, we care about what happens at the margin. We care about the delta of improvement, or perhaps where it might be where things deteriorate. But in this case, South African growth is improving, and we're in a small club, relatively small club globally, where that is the case, where there's positive delta.
Okay.
So it's not that you and I, Addy, are going to notice that there are fewer potholes on the street, or that the water leaks have been fixed.
Or that load shedding is not around.
Well, load shedding has been fixed. So that's one example of the reform agenda having delivered results, and that's partly why South African growth is improving, because we've left behind the load shedding in a material sense. But what I want to make the point that you and I are 10 years away from seeing better roads and better water infrastructure, but markets don't care about that, not directly, and markets will tend to get ahead of this sort of stuff. It's also true that our political analyst Simon Fremantle is also constructive, and he has talked about tailwinds, as has Elna, and he is broadly positive for the year ahead. And I think that we're going to notice that in particular with the budget that's coming up next month, because the budget will demonstrate its commitment to fiscal responsibility, and most importantly, we're not going to sit through 3 iterations or more of the budget, because the GNU has learned from its mistakes. This is our view, and will deliver a budget that is well shared and well agreed to in advance, so that we can avoid the problems that we had last year. There's also going to be less strain with the US. Now, believe it or not, that is the case. We have many problems, not least in the South African National Defence Force. The order came down for those Iranian ships to stand down from the drills, and the SANDF actually nevertheless went ahead. So we've got problems in with our military, just as we have problems with our police. These are problems that will need fixing, and certainly I'm not here to argue that life is rosy here in South Africa. I'm here to tell you what the markets look like, and the markets are encouraged that the reform agenda has political support, that labour relations, the outlook for labour relations this year is benign. We're not going to see enormous and widespread labour unrest. And all of these are positive. And these charts below, which are Simon's charts, show that confidence is improving from a low base, you'll argue. And I say I absolutely agree. But again, remember what I said, it's about the delta and the direction at the margin. So things look positive, but we're not without our risks. But Adi, as we've been saying for a while now, the JSE is cheap, and investors generally are looking to own it. Foreigners are starting to come in a small way. Reform agenda has a tailwind, and we're earning a lot of dollars courtesy of metals and commodity prices. So right now we're in a good place.
Well, it's a great outlook and a great positive spin, considering what's going on. But yeah, as we know, Tom, markets change and news comes out in a flash. So the fact that you're always here to help our audience understand it, unpack it, and just make sense of it is really appreciated. So once again, thanks for your time, and looking forward to chatting to you next week, Tom.
Thanks, Adi.